Hey, good morning. This is Ralph Mendez. I really apologize. I need to do chapter 10, and it's a very difficult chapter about bonds and things. So let's see what we can get done. The first one, number one, you're issuing a bond with a par value of 230. Now remember, the par value is the same thing as the face. There's no difference. Like here's a little bond, face $5, United States of America bond, state of Louisiana, $5. So that's the par, it's the face value. State of South Carolina, $1,000. So the par and the face are the same thing. State of Georgia, general obligation bond, 1982, $5,000, the principal sum. 82, so the par and the face amount are the same thing. Record the issue of the bonds with a par value of 230. So right away, bond par value, face value is what you owe people. You owe people the face value at the end of the bond. Now, it said it issues 10% 10-year bonds with a par value of 230,000. On the issue date, the annual market rate is 12. So the market's 12. We're only paying 10. So who's paying more? The market. So they can go somewhere else and get 12, and we're only paying 10. So they're going to discount us, and that's why we only sold our bond for 88.5%. In 88.5%, how many decimal places do you move it over to change it from percentage to decimal form? 2. So 0.885 times 230,000 means we raised cash of 203,550. So there's the cash we received. And you see that the debits and credits don't match up. So it's a discount because we're paying. Why is it a discount? Because we are paying less. We are paying less than you can go on the market. So I just started with an I knew the bond pays 230, the face amount or the par. How much cash? 88%. And the difference is the discount. Now, I'll show you one more image here. Here's a bond, 500,000. It pays 9, but the market's 12. So the market's paying more. So what's going to happen? If the market is more, the market's going to discount us, and we're going to get less than 500,000. So in this case, they sold it for 463. Now on this bond, 400,000, we're paying 13, and the market's still 12. So they're going to pay us more. We're paying more than the market. So we actually sold a 400,000 par face value for 409. So that's where you get this bond premium and bond discount. All right, let's check our work. And let's go on to number 2. Now, what happens is Enviro Company issues 8% 10-year bonds with a par value of 180, semi-annual payments. On the issue date, the annual market rate, the market is 10 and we're paying 8. The market's 10 and we're paying only 8. So the market's going to discount us. So we only got 87.5%. So 0.875 times 180,000 is how much cash we raised. We don't get the 180. We only get 87.5% of that. So 0.875 times 180 gives me the 157,500,000. So that's all the cash we raised. So do they want a journal entry? No, they don't give us a journal entry. So cash would be debited by the 157.5. Now, here's what else. If it's 10 years and they pay you twice a year, semi-annual, 10 years, and you get payment every 6 months, how many payments are you going to get? 10 years, 2 payments per year. 20. Now, how much interest are you going to get? Well, they pay 8% annually. 8% annually. So what's 8% of 180,000? 14.4, but you have to divide by 2 because you get it every 6 months. So important thing to learn, if the semi-annual, you multiply the number of years times 2, but you divide the interest divided by 2. So that if it's 10 years semi-annual, the number of periods are 10 times 2, but the interest is divided by 2. So you don't get 8% per year, you get 4% every 6 months, or if you want to think about it like that, or 8% for the year divided by 2. So now that's how much interest you get over the 10 years. Now what? You get the par or face value. You get the par or face value. You get this par or face value at maturity. So this is the total amount that you have to repay. We're the company issuing. You got to pay this much interest. You got to give them this. Here's your total repayments. Now, how much money did you raise? We didn't raise even 180. We only got 0.875 times the 180,000. So we only got 157.5. So we got 166 is our interest expense over the whole life. So this is the cash. We only got 157 instead of 180. And yet when we have to pay it back, we got to give them 180. So this is a discount. And this was, what is the amount of bond interest expense recorded on the first interest payment? Well, that's kind of complicated because not only is it the 7,200, but you have to amortize this discount. 157, 180 minus 157 equals 22,500 divided by how many periods are there? There's 20. So you take that discount divided by 20 periods. So not only do you pay the 7,200, but you have to amortize the discount, and it should be 83.25. So it's the amortization of the bond discount plus the actual cash interest you give them. So let's see if we're right. So the bond interest is more complicated than you think. So cash proceeds, yeah, we got 87%. You got to make 20 payments to 7,200, and we got to pay this out. So this is a total amount we got to give these people that loan us the money, and we only got 157. So our interest expense is the difference. And this is the first interest expense. Now let me show you how this works. Right here is a discount. We got to pay 10,000. We only raised 9, so our discount's 1,000. Everybody see that? 10,000 debits, 10,000 credits. And it happens because the contract's 9 and the market's 12. So the market's paid more than we are. Now, here's the discount. Now, how do we do this? Now, let's just say that we're paying 10% on this $10,000. Okay, so 10% is 1,000 per year. But you make 2 payments a year. 500, 500, 500, 500, 500, 500, 500, 500. Okay, does that make sense to y'all? You got to pay $500 every 6 months. June, December, June, December, June, December, June, December. So you got to make 2 payments a year of 500. So at the end of the year, the last 5 years, 1, 2, 3. So assume this was issued this year, 21. Here's 21, 22, 23, 24, 25. At the end of this year, the last 5th year, they get the 500 on that last date plus the 10,000 par value. And here's your journal entry. We got to pay them the 500 cash every 6 months. For 5 years, we got to give them 500. But we only got $1,000 less. We have a discount of 1,000. We have a discount of 1. So 1 divided by, well, how many periods are there? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 5 years times 2 payments a year. So this 1,000 divided by 10 is $100 every time we make an interest payment, every time you give them a cash, you got to amortize this. And because you got a discount, you only got 9, it's actually extra interest expense that you have to absorb. The company has to absorb $100 each time. 10 payments will be the 1,000. Because look, this discount is sitting over here with a $1,000 debit. So every time you make an interest payment, you're going to credit it 100, so that at the end of the 5 years, because you got to make the payments 10 times, right? Right? 1, 2, 3, 4, 5. So after you've done 1, 2, 3, 4, 5, 6, 7, 8, 9, there's the last payment now in 2025. So now it'll be 0. It'll go to 0. So you have a debit, so you credit it. So right there, discount on bonds credited. So the original entry. So you have 2 types of interest expense. One, you got to give them cash, and the other is amortizing this discount. Now, in your accounting, it's going to want you to combine these. You know what I'm talking about? It's going to want you to put this plus this 600 in the McGraw-Hill. It's going to want you to do that kind of thing, right? Everybody understand the interest expense is 500 plus the other. I wish you could do them separate, because it's really two things going on. One, you got to pay them the cash, and the other is you're amortizing the bond, the discount on the bond. But for our purposes, you delete that and you combine it together. All right. So that's how we got that bond interest expense. It wasn't just the 7,200. We had to add the discount on bond. All right. So we got that. There's another one. It's exactly what we just did. Exactly what we just did. A discount, record the issuance of the bond. And in this case, it's 210, but you only got cash of 201. So you have a discount now of 8,200. Okay. So it wants you, so you do this one, then you record the interest payment on June and on December 31st. And these are the exact same. You got to make that same entry for however many periods there are, 5 years, semi-annual. So you got to make that same journal entry 10 times. So here you just get cash of 201, and yet you owe 210. So your bond payable is 210, your cash is 201, and your discount's 8,200 debit. All right, so y'all can do that one. Now, how about this? Record the issue bond with a par value. Is this used as straight line prepared journal entries? Is this a discount again? Oh, par value. Again, it's a discount. So record the issuance with a par value of 92,000 cash. What is here? 92 cash. Oh, no, the par value is 92 with a par value of 92,000 cash. The carrying value is 85,427. 85,427. 92,000 is the par value. And 65,73 is the what? This is the cash. Here's your discount. And there's your bond payable. So always go with what you know. You did not raise that. And you can see right here, the unamortized discount is a 65.73. So when you make the interest payment, you take 65.73 and divide it by 8, because there's 8 periods. And then you pay the interest of how much? 4% of 92,000. So that's what it wants in these next 2 entries. So remember what I showed you here. 2 different things going on. Pay the cash, amortize the, there you go. It's extra interest expense. All right. Okay. So there you go. Now I want to get to a premium, because y'all should know how to do the discount now. All right. So now we have a premium bond. Under using the implied selling price of 124%, what are the cash proceeds? So we multiply this by 1.24625. So this $300,000 bond sold for a premium. So you take 300,000 times 1.24625. So it sold for 373,875. So this is a premium. So the face value is 300 and we got 373. Okay. Now it says number 2, what total amount of bond interest will be recognized? Well, let's figure that out. It's a 10-year bond, semi-annual. So how many payments are there? 20. And what is the interest? 10.5% on 300,000. So 300,000 times 0.105 is 10% per year divided by 2 because it's semi-annual, 2 payments per year. So it's 10 years times 2. So you multiply the period times 2, but the interest rate you divide by 2. So this is 15,750. So it's 5.25% times the 300,000 is to 15,750. So it's not 10 payments of 31,000. It's 20 payments of 15,750, and you have to pay back the people 300,000. So 600,000. And how much did we raise when we collected it? 373. 875. We got a premium. So there's our interest expense. Now, on your first 6 months later, you got to give them 15,750 plus you have to amortize the premium. It's a $300,000 and you raise 373. So the premium is 73,875. 73,875 divided by 20 periods is 3693.75 plus, oh no, it's minus because it's a premium and it reduces your interest expense. Okay. So there's our cash proceeds, 20 payments of 15,750. We got to pay him $315,000 interest in cash. We got to pay him $300 at the life. The total repayments we give are $615, but we got to borrow initially $373. So this is our interest expense. So 6 months later, you have to pay him $15, but then you have to amortize the $73,000 premium, and it reduces the interest expense. So let me see if I can show you an example of now in this case, instead of raising cash of less, you raised 11. So you have a premium of 1,000. And look, instead of it being a debit, you have a credit. Instead of having a debit, you have a credit. So a premium is on the credit side. So now let's just say again, we're paying these. Let's just say we're paying $500 every 6 months. So we got to give them the $500 cash. But you have to get rid of this premium by debiting it. So look, the premium on bond is a debit. So 1,000 divided by, it's a 5-year, 2 payments a year. So you divide that by 10. So it's $100 premium. And the interest expense is credited. That's why, see, interest expense goes up. But because you raised extra cash of 1,000, it reduces the interest expense. Now, again, McGraw-Hill is just going to combine this. So the interest expense is going to be subtracted. 500 debit minus 100 credit. So this will become 400, and this will be deleted. And that's your entry, what it'll look like. You understand? So what I don't like about it is that all of a sudden the students are thinking, well, there's two different journal entries, but you combine it in McGraw-Hill and you're saying, well, where did that come from? It came because 2 different things. 1, you have to pay them the cash you owe them. And 2, you have to amortize your premium. So now look what happens. There's year 1, 6 months, next 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 6 months. So the premium is going down. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So now that's this date here on the last payment. We got to give them this, plus we have to give them their money back. We give them the par face value, plus we give them their interest payment. So at the same time you're paying interest, you're also amortizing either your discount or your premium. Now, the carrying amount. The carrying amount is the face amount plus the premium or minus the bond. So I'm going to show that over here. Here's the carrying amount. The face amount, this was a discount. The carrying amount's 463. And after your journal entry, it's going up and it moves to the 500,000. Now down here we have a premium, 400, but we raised 409. So the carrying amount is the 409 and minus the interest expense. So it's going down towards the 400. So the carrying amount is just the face plus whatever premium there is or minus the discount. All right, so now let's see over here. We did these. Oh, where were we at? Did we do this? I guess it checked it for us. Okay, very good. So that's a premium. Number 6 is a premium. It's 115%. You can do that one. There's another premium. See, the bond's 102 and it raised 110. And the carrying amount goes down as you amortize. So y'all can do a premium. Same thing again, a bond premium. Now let's do this because remember, always go with what you know. So on July 1st, Aloha exercises a call option. It requires Aloha to pay cash. So it wants to call this bond back. So it has to pay $204,000. There you go. It have a carrying value of 206. So think about it. The bond payable has a credit of 200. So to get rid of it, we're going to debit it bond payable for 200. How come I can't find bond payable? Where are you, bond payable? There we go. So the bond is a $200,000 bond credit. So when we buy it out, it closes with a debit. We have to give cash at 204. We're going with what we know. Well, the carrying amount is 204 and the par was 2. So we know we have a premium. What was the balance on a premium? Remember, a premium has a credit balance. See, after this one, the premium is 900 after the first 6 months. So to get rid of a premium, you have to debit it. So we have to debit it the $4,000. So amortization. Let's see, premium on bond. So there's that. So this is how much cash we got to give. This closes the premium on bond account. This closes the bond payable. And is that it? 204, 200. Oh, I'm sorry. The carrying amount is 6,400. So this is 6,400. Now we don't balance now. The debits don't match the credits. I need what? Do I need a debit or a credit? A credit of how much? 2064 minus 204, 2,400. Now this is cash here. Got to pay out this cash. And this is a gain on retirement. And let's check our work. So again, go with what you know. You know you have to pay cash. You know you got to close the bond out with a debit. You know the premium's a credit, so you have to debit that as well. And then the last thing we did was figure out, well, do we need a debit or credit to balance? And we needed a credit, so that's a gain. So on retiring the bonds, we have a gain. Now, compute the bond prices, but this time you're going to use a table to do this. And these are present value tables. And so there's the carrying amount of a bond is also known as the book value or carrying amount of the bond. It is nothing but the sum total of the face and the unamortized premium or less any unamortized discount. And let's see here. Cash flows, discounted cash flows. Okay. So we're having to, so now what's happening is now you have this money here, year 2021, 22, 23, 24, 25. And we have this bond, but what happens to discount it? What is it worth today? What is this bond worth today? So you're going to get 1,000 a year, 500 every 6 months. plus you get 10,000, but money in the future is worth less because of inflation, as you study in your economics classes. So let me just see if I could also show you now. Here, the bond pays 9, the market's 12. Here, this bond pays 13, the market's 12. So what affects the value of this bond, if you try to sell it, is the market value. The market's 12. In this case, we're paying 13, so we're going to get a premium. In this case, we're only paying 9, so they're going to discount us. But if you're trying to figure out the value of the bond, what it's trading for out there, we use the market rate of interest to discount or give us a premium. So it's a hard concept. So let's go back here. So it's 208,000, and that's a single sum. Remember, that's just one sum in the future. There's the par. Whereas this is a set of equal payments. So with this, we use the present value of $1. But because it's a set of equal, we can use the annuity tables. And all that is they've been added up for us. The individual factors here have been added up. So here it is. So now we need to B1, present value of $1. Oh, now which one do I use? What do I use? Well, you have to use semi-annual. So remember, we multiply this by 2 and divide this by 2. Multiply this by 2, which is 20. Divide by this by 2, which is 4. 20 periods, 4% interest, 0.4564. 4564. That's the factor. Oops. 0.4564. 0.4564. 0.4564. 0.4564. 280,000. So we're saying that's worth today. We're saying that in 10 years, 280,000 is only worth 127 today at 8%. Now, what about the interest we get? Well, it's the same. The interest payment, 8% of that is 16. So let's see. Let me just check my math. 0.08 times 280,000 is 22,000 divided by 2 is 11.2. It's 11.2 every 6 months, but it's the same. It's the same for 10 years. So I can use the annuity tables. Well, which table do I use? Well, how many periods? How many years? 10 times semi-annual. So this is 10 times 2, and this is 8 divided by 2. So I need 20 and 4. I'm going to go to 20 and 4. So the present value annuity is 13.5903. 13.5903. And that's worth 152,000. And you add that up. It's 280,000. I made a mistake already. I can see I made a mistake. What did I do? I didn't listen to what I was telling y'all. The market rate is 10. See, and I've been using 8. And I even showed y'all. I showed y'all right here. You have to use the market rate, not what the bond's paying. So I'm glad I made the mistake. So to evaluate the bond, I didn't even do what I told y'all. You have to use 10 times 2 is 20, and 10 divided by 2 is 5. So I got to go do this again. 20 and 5 is 0.3769. 0.3769. See, the bond's paying 8, but to evaluate it, I got to use the market. See, I made a big mistake, but I'm glad I made it. Now here, again, 20, 10 times 2 periods per year is 20n, and the 10 divided by 2 is 5. So I've got to use 20 and 5. 12.4622 There you go. 12.4622 times 11.2. 139,576.64. And I add these up. Now, if I'm only paying 8 and the market's 10, is it going to be worth more or less? Am I going to get a discount or a premium? It's a discount. I'm paying less. .37 times 280 is 105,532. And let's see. All right, so now that's right. So I just got to do the math now. 105,532 plus 139,577. 245,109. So the bond, the face is 280, and yet today's dollars, y'all are only going to pay me 245. So let's look how this looks. So in our image of the timeline, I have to pay 280,000 here, 280, but today's it's only worth 245. So see, it's discounting, bringing this back to today. What's that worth today? What are all these cash flows worth today? So you're discounting the cash flows in the future back to what they're worth today. So that's what the problem's asking you. Okay, number 11, let's see. This is the same thing, but let's just walk through a few things here. The company issues bonds with a par value of 16. The bonds matures in 9 years and pays semi-annual. So what's 9 times 2? 18. In the interest, the market is 6 divided by 2 because, so there's what you use out of the tables. 18 and 6 for the interest. 18 and 6. So the par at maturity value, so that's a single sum. So I go to 18 and 6. 18 and 6, 0.3503. And what about the interest? The interest is for 18 and 6, but it's for an annuity. So it's 10.8276. And then you got to multiply, what do they want here? Oh, times time value. You multiply time value times the money. Okay, so take 0.3503 times our 610,000 is 213,683. And over here, how much interest? It's 610 and it pays 9%. 610,000 per year times 0.09 divided by 2. So it's 27,450. 27,450 annual interest. Semi-annual interest. Okay, and what's our factor though? The 10.87. So that's 297, 217.62. So let's just see, and what does it want here? Record the issuance of the bond. So the cash, we are the ones selling the bond. We're the company. So we received 3293. $3293011. That's how much cash we get. Then we have a bond payable. What did I do wrong? So, oh, my math must be wrong here. Interest. So the interest is 610 times 0.09 divided by 2, 27,450 times 10.8276 is 297. But that ain't the present value. I've already multiplied the present value. This should be, I don't know why I put that number out here. Interest. Oh, I know what I did. Let me try this. It should just be 27.5. 297.27. I'll do it one more time. 610 times 0.09 equals divided by 2, 27,450. There you go. There's the number I wanted. So it's 372,071. 372,071. I have a discount. Bond payable. $610. Goodness, look at the discount. Is that really that much? 610 minus 372,071. There's no way I could have a discount that much, right? I think I've got some mistake somewhere. Let's see if I did it over here again. 35. Oh, no, at the par, I need to enter this 610. There we go, 510, 510,901. $901, this is cash. And now I take the difference. So 610 minus 510, 901, 99,099. Goodness. Let's check my work. Am I off $1? No, that's what they wanted. Okay, so 2018 is the number of periods, 9 times 2. 9 divided, interest is 12 divided by 2. That's what, it's the market rate we use, not the 9%. The 9% is used to figure out how much interest we get. We get 27,450. 9 times 610 divided by 2. All right, and then cash, we have a discount, really almost $100,000. All right, and let's see, this is the same on the last one. So I'll just help you get started. 6 years, semi-annual. So how many periods are there? What's the end? 6 times 2 is 12. And what rate of interest do you use? The market. The market's 8 divided by 2, so you're going to use 4% there. And now you're going to go to those tables. The table value for 12 and 4, so you go down to 12 and 4 is 0.6246. And don't make the mistake I did here. It's times, it's the factor times the money. What's the face? 74,000. And what is the interest now? It's 9% times 74 divided by 2. $33.30. But now we need the annuity factor for 12 and 4. So it's 12 and 4 is 9.3851. 9.3851. So then there you go. Now you just have to make the journal entry. Okay, how much cash do you get? How much cash do you get? Present value is 77. How much do you owe? 74. And let's see, we're paying 9 and the market's 8, and that's why we have a premium. 74, so the premium is 77 minus that. All right, I hope this helps you and have a wonderful day. Thank you. God bless.